Warm welcome to this webinar where we are going to give you a quarterly update on Res Life investments and also share a few new initiatives. I'm Andreas Julin and I'm heading up the sales marketing team at Finserv Nordic. As most of you probably know, Res Capital merged with Finserv Nordic in the fall of 2025. And the new company manages approximately 1.5 billion euros in thematic and alternative strategies. We are 21 employees, and Gustav Hagerud, the former CEO of Res Capital, is now the CEO of the new company. Just shortly about our offering that you can see on this slide. We are, as I said, a thematic and alternative asset manager. Aside from Res Life investments, we also manage the Finserv Global Security Fund. It was the first and today the largest actively managed global defense fund in Europe. It has 7 years track record, strong results, both absolute and compared to peers. It is backed by a seasoned advisory board comprised of domain experts within defense, space, and cybersecurity. Thanks to its low beta of around 0.3, it may serve as an equity replacement solution in institutional global equity allocation. Then we have the Nordic Factoring Fund, our true capital preservation alternative. Was launched in 2019, has a target return between 6 to 7% in euro. The credit risk is very strong. It's minimum 80% investment grade and also very short loan duration between 15 and 60 days. We haven't had any credit losses in this fund since inception, and it can serve as an alternative fixed income replacement in an institutional portfolio. But back to Res Life investments, and as part of the merger between the two companies, the investment management function was transferred from Res Capital to Finserv. The team behind remains the same, and I think that could serve as a good segue to also introduce my colleagues into the discussion. Anton Pozine, lead portfolio manager, been with the firm since 2011. And then, of course, Jonas Mårtenson, the founder of Res Capital. And I'm going to start with you, Jonas. It's been an interesting year. I think we can say that for sure. Could you give us an update on the market for longevity investing and also on a high level the fund?
Yeah, no, thank you, Andreas. It's great to have you on this webinar. We actually celebrate our 15th anniversary this month. So we launched the fund in April 2011. So the NAV coming out in a few weeks will be the 15th anniversary now. We have really seen the market going up and down, even in the life insurance policy market. Returns are now at a really attractive level. When we launched the fund in 2011, we can just maybe show a bit about how the market has evolved. So next slide, please. When we launched the fund in 2011, the returns were very attractive. This was after the great financial crisis, and we were buying policies at returns around 14, 15, 16% gross IRR in US dollar terms. Over the years, more capital flowed into this niche asset class. Many larger players became aware of life insurance policies, and we had Blackstone, Apollo, PIMCO, etc. Entering this asset class. As a result of these capital inflows, returns decreased over a long period of time. And this we've obviously noticed. What we saw happening in about 2 or 3 years ago with higher US interest rates is that many of our peers in the US use leveraged when they manage their funds. And as a result of these higher interest rates, many of our US competitors stopped buying life insurance policies. As a result, supply and demand really changed, the dynamics really changed, and we are now one of the few buyers. Obviously, there are a few others, but many have stopped buying completely. and are trying to reduce the leverage, trying to sell policies. And as a result, we now see very attractive buying opportunities, both in the single policy market, where we buy directly from the consumer through regulated brokers, and in the portfolio market, where we buy from other fund managers who are looking to sell smaller blocks of policies. Anton will speak more about the returns that we're seeing, but this is a drastic change. We also took a decision to sell our portfolio about a year ago, since we realized that the opportunities were quite fantastic in this asset class. We are aware that the performance last year was not the highest we've had. We have nevertheless shown positive performance since 2012. But the challenge, of course, was to sell the portfolio to one large single buyer in the US, and then to redeploy the proceeds into buying new policies at higher returns. And of course, those policies will not pay out immediately, but we've seen some encouraging returns already in the first quarter, which Anton will speak more about. Thank you.
And if we take the investor perspective, we have all been traveling quite a lot last year. What is a common theme, think about investors in regards to their allocation, but also in relation to the feedback that we have received?
I think the strategy performed very well when interest rates in the US were around zero. I mean, 7% net in US dollar terms, uncorrelated returns with interest rates being zero. And of course, investment grade credit rating for most US life insurance companies. That worked very well for many years. But what we did see was that with increasing US interest rates, this wasn't really enough. So we took this strategic decision to sell the portfolio in order to reinvest and redeploy into policies with higher returns. So we're in a bit of a transition period right now. We really appreciate our investors' patience. We are aware that returns last year were not fantastic, but we are very positive about the future.
I mentioned in the beginning that we're also going to share a few new initiatives. The dollar has been tough for us the last year. There has been a dollar aversion in the market in general. But it feels like the interest for the strategy, what we're doing, remains. So therefore, we are also setting up a new fund. Can you elaborate a bit on that?
Yeah, no, thank you, Andreas. And let's have a look at the next slide here. Many of our European investors in the last few years believed that the dollar would depreciate, and they were quite correct. So we've had outflows in Rest Life investments since approximately 2.5 years. About 6 months ago, we were approached by a large European multifamily office who told us that we like the asset class, but we would like to have the returns in euros. As a result, we are jointly setting up a feeder fund called Longevity Strategy Fund, where we will hedge the US dollar returns of Rest Life investments into euros. So it's a very exciting time for us. We are expecting to launch in the coming days, and we have approximately 25 million euros, which will be deployed into buying shares in Rest Life investments, which then ultimately will, of course, buy more life insurance policies. So it's a pure feeder. The only thing that Longevity Strategy Fund will own will be shares in Rest Life investments, which they can buy through the stock exchange or subscribe for new shares. So it will benefit our investors in Rest Life investments. Since AUM will increase, we will be able to buy new policies at much higher returns and gradually increasing the returns in Rest Life investments. So a very exciting moment for us to launch this fund. And we will also offer a lower management fee in the feeder fund for the first initial investors, but the seed investors approximately about 25 million euros.
And I think also it's important to stress what you said, that this will benefit all shareholders in both Rest Life investments and Longevity Strategy Fund.
Yeah, no, I agree. This is really key. So all the money coming into Longevity Strategy Fund will go straight into Rest Life investments, which will buy the life insurance policies.
Thanks, Jonas. Anton, we recently published our annual report for 2025. Can you tell us a bit about the performance attribution, if we can get that slide up on the screen?
Yes, of course. So, as both you and Jonas have already mentioned, last year was sort of a transitional year for RES Life Investments, since early in the year we sold our old portfolio, which we had bought during the previous 15 years. And that obviously affected the performance of the fund during the year. So if we look at performance attribution, we can see that realized performance was lower than previously and obviously below expectation. But that was mostly because we had sold the old portfolio, and that meant that during the year we received a smaller percentage of the maturity proceeds, since we had sold the portfolio in tranches. So during the year our exposure to the old portfolio decreased. Another effect of us selling the portfolio was that the aging effect was basically zero, because the purchase amount was locked in during the sale for each tranche, and that meant that we didn't revalue the policies as insurers got older, which led to basically no aging effect. So those were the main drivers behind the lower performance during 2025.
So returns were lower than we had hoped for in 2025, even though we ended the year on a positive note. We had a strong fourth quarter, and that has continued into 2026. What can investor anticipate in terms of performance, looking at the rest of 2026, and if we also look into 2027?
Well, so the main drivers of performance going forward are obviously still, to some extent, the legacy portfolio, the old portfolio that we have sold, and the performance in it. But more and more as we go forward, the main performance driver will be policies in the new portfolio that we are purchasing. And as we can see in the next slide, here is basically just the purchase IRRs for policies that we either bought into the new portfolio or are in the pipeline being purchased now. And both charts show purchase IRRs, but compared to face amount in the left chart and remaining life expectancy in the right chart. And as we can see, well, number one, the purchase IRRs are much higher than the around 12% growth that we had in the old portfolio. We can also see that the IRRs are higher for smaller policies, 2 million in face value and less, and perhaps also for the very big policies. And that's mainly driven by the fact that the remaining buyers currently in the market are very large entities that purchase mostly portfolios in the tertiary market, and perhaps some very big policies in the secondary market, which means that there are fewer buyers for the smaller policies, and that leads to even higher gross purchase IRRs for them. If we look at the right hand chart, we can see that there is really no difference in the remaining life expectancy affecting the IRR. The main thing is that the purchase IRRs are just in general much higher today than they were before. And as we can already see now, and hopefully we will see even more going into the rest of 26 and into 27, this will have a positive effect on the fund's performance.
So if we look at this, I see that the average size of new policies we're buying is lower than what we have in the legacy portfolio. Is that because change of views, or any particular reasons around that? Or have you taken other kind of actions when you build a new portfolio as well?
Well, so obviously we have been doing this for, as Jonas said, this month it's 15 years. and we have learned certain things. We have learned that in an open-ended fund, certain things that look good on paper maybe do not fit as well as in a closed-ended fund or in a different structure. For example, well, as you noticed, we have decided to buy fewer of the very big policies on healthy individuals because they have a good risk profile very long term, but in an open-ended fund where we need to publish a net asset value every month and where we have perhaps investors that are looking to invest for a 5-year horizon, it maybe doesn't fit as good. The same thing is we used to buy a lot of joint life policies on healthy individuals. And we realized that maybe in an open-ended fund, they really don't fit. I would happily add a joint life policy into my own pension account where I would need the money in 40 years, or perhaps. But they do not really fit as well into our structure. So we have done some changes to the investment process, yes.
Mm-hmm. So a larger part then of the portfolio policies that we buy on the portfolio market with then somewhat shorter life expectancies.
Well, yes, I would say that it's also partly because in the tertiary market, the insurers are obviously getting older and older. So the life expectancies are shorter, not because the insurance are less healthy now, it's more because they are older in general. So their remaining life expectancies are shorter now.
Okay, thank you.
I guess maybe one question then that will hang in the air is, are we taking more risk then, Anton?
Well, the main risk measure for life settlements is, well, obviously it's longevity. And if you buy unhealthy individual policies on less healthy individuals, you maybe take more risk. But the main risk is the structure of the policy and how premiums in the tail look. So if we manage for that, we still can avoid taking more risk. And in terms of credit risk, obviously we only buy investment grade carriers or higher. So no change there.
Okay, so we are approaching 20 minutes now. That means that we're done with the first presentation part. Now it's time for Q&As, and we have already received a few questions, but please take the opportunity to send them to me, andreas.julin@finserv.se, and we will pick them up under this next session. Okay, so the first question is with regards to the EGM decision, especially regarding redemptions. I think that one is for you, Jonas. If you could comment on the EGM decision and especially talk about the redemption.
Yeah, thank you. So the EGM in January decided that redemptions will be allowed starting 1st of January 2027, and we had approximately 75% of the people present at the EGM voting in favor of this. So we are aware, of course, that this is a decision that was negative for some investors, but the aim really was to use the proceeds from the portfolio transactions to enable us to buy new policies at considerably higher IRRs. And we've seen some of this already happen in the first quarter, where we are close to 3% net return. So we are confident that the new portfolio will deliver in due course. But thank you.
Also have two questions here talking about the IRRs. And we talked about that. You mentioned that we bought the policies around 14 to 16% IRR. Those level has come up quite a bit. We're now buying from 15 to 25% IRR. So Anton, this one's for you. Could you explain what has happened in the market? Why IRRs have jumped?
Basically, if we go back a few years, we were buying even lower. We were buying at about 12% gross IRRs. And what happened is that this market is mainly driven by supply and demand. And what happened was that a lot of our competitors basically stopped buying in late 2023, 2024, and what happened is that the supply is still the same as it used to be, because at the end of the day, it's insureds who are selling the policies, while demand sort of went down significantly. And this has provided us an opportunity to buy policies in the secondary market at much higher IRRs, and even some blocks in the tertiary market. I believe that this is something that will not stay. I believe that as soon as the demand comes back, the prices will sort of go back to where they used to be several years ago. So I believe that the period with high IRRs is sort of temporary.
We have also obviously talked about the legacy portfolio and the new portfolio that we are currently buying, proceeds from the transaction. When will the fund only own new policies?
Okay.
I think that is one for you as well, Anton.
So as I understand the question, basically, when will our exposure be only to the new portfolio? So there are several parts to this answer. Number one, we are selling our portfolio in tranches, and that transaction will be done by end of Q3 2026. And then we have an exposure to performance from that portfolio for after that, which will be a part even going forward. However, as we reinvest the proceeds into new policies, obviously the portion of the performance that is provided by the new portfolio increases, and we believe that towards end of this year, a big part will be performance will come from the new portfolio. But it's impossible to say because it all depends on how we are able to reinvest the funds. Currently, that opportunity is very good, but I can speak about the future.
I think that those were the questions that we have received. Obviously, if you still want to ask questions, there's still obviously some time. But I think we can probably leave it there. We're of course available should you have any questions that might come to mind after this webinar. But I think that we want to say thank you to the audience. Thank you for participating. We hope that you found this valuable and an insightful webinar. And we look forward to seeing you soon again. Thank you very much.
Thank you.